Yeah, I'm losing my
Talk
head.
about it. Management mechanics for day trades, a lot of day trading going on, especially as you start to see places like the small exchange or the CME starts to launch more and more micros. Everyday people, Jermal, are able to day trade with efficiency and with lower risk and smaller size. But I want to make sure that everybody has their mechanics in line because that's the next piece. Of course, you want to make sure that your risk is where you feel comfortable. You've got your strategy in terms of buying or selling on the intraday basis. But the final piece, but what is essential is to make sure that you aren't just out there winging it, Jermal, is the mechanics, right?
Mechanics is a big part of it because, otherwise you are winging it and you don't necessarily know which way is up. You can really get confused fairly fast, right? I mean, we have a move like this morning after we had been down, not only the last couple of days heading into the weekend, but throughout the weekend, you start to make a move to the upside like we just did today. All of a sudden, you don't really know where do you want to close, right? Or sell, period. You can easily get confused based on different levels. And so I think it helps to have some type of mechanics with regard to day trading.
I'm glad you bring that up because when stuff starts to heat up and markets become more volatile, like we're seeing in the technology sector in equities, but we're also seeing in energies and interest rates almost everywhere, Jermal, as all those asset classes heat up, become more volatile, opportunity goes through the roof, right? Like that's volatility synonymous with opportunity. But as those things heat up, if you don't have your management, if you don't have your mechanics set on the front end, there's no worse feeling than everything moving and being like, all right, where am I in? Where was I supposed to get out at? I mean, look at it this morning. You could have bought tech stocks on the downswing over the last 24 hours, pitched them out today for a real nice profit, and now they're edging back down towards those levels that you could have bought them at. Look at the last 12 months of trading in the small technology futures, Jermal. It's a ton of back and forth. You could be selling and buying this thing intraday, multiple days per week. And so while volatility does make for the best day trades, volatility in these markets heating up can get you really screwed up if you don't have some mechanics going into the trade. And we base almost all of our mechanics, whether it's derivatives in the option space or the future space, Jermal, around the standard deviation. And that is what feeds into implied volatility. And that lets us know when to get in and out of positions. But in futures, this standard deviation, knowing where this market tends to live, and then watching for it move outside of that range, and then hoping for it to come back in if you're a contrarian or a trend follower, hoping it to get out and then stay out, move out. This is what dictates our entry and exit, that's mechanics, right? Entry and exit.
Most definitely. I think, and up and down. I think that's the big thing for people to remember. Understanding that volatility does work in both directions. It can mean a percentage move to the downside by X percent. It can also mean percentage move to the upside by X percent. So I think, when you talk about volatile markets or create opportunity, I think there's nothing more needs to be said than that. That really kind of nails it.
Absolutely right. And I'm going to make it real clean for everyone starting out, right? Like at the end of the day, you know what works for you. Like there is room for your own artistry, your own creativity to kind of dictate like, all right, I hear what Frank and Jermal are saying. I'm going to do it a little bit this way because that's the way I trade, or a little bit this way off of what they're saying. That's totally up to you. But I do want to create kind of the bare bones of management. And it looks a lot like those of you out there who have built management mechanics on trading options, right? Like options get expensive. I sell the iron condor or the strangle or whatever, and then I manage for half of the credit that I got, like very simple. And you can tool around with that, right? Like, oh, I'm more aggressive, so I'm going to sell something that's an aggressive trade and only look to take 10 or 20%. That's totally up to you. It's the same mentality here where it's like, Jermal, the market, today's a good example. Small technology futures move down by more than $1. I buy a contract at a net change of negative, let's just call it $1. Mm-hmm. I'm looking to cover for a profit, and the market did come back to unchanged, and you could do this, a net change of negative 50 cents. It's just half of that expected move is where I'm looking to take profits. That makes sense, right?
Yeah, it does, man. I think, the idea of setting realistic expectations is the most important thing here.
Exactly right. Because like, look at if you had unrealistic expectations, which is to say like market's down $1. I know that's the standard deviation. That's kind of my get in point here. I'm going to hold for $3 in profits. It's like, you ain't getting that done, dude. You ain't getting it done. And you would have seen this morning, market rallies back to unchanged and then comes back down. And if you did nothing in between there, you missed it. And now you're just long that contract and it's back at where you entered, as opposed to market moves down $1, rallies back to unchanged. I get out for my 50-cent profit. It moves back down $1. Now I'm playing with house money and I can either take another look at that trade or I can stay away from it and call it a day. Now, when we do get caught up in these outliers, it can't all be good times. There's going to be plenty of times where the market moves down $1 and then it moves down $1.50 and then it moves down $2 or $3. But you have to be looking at managing those losses as well. I know there's defensive mechanics for options trading in the futures world, especially day trading. I don't know what kind of defensive mechanics you can put on something that you're expecting to have for a couple of minutes or a couple of hours. For me, it's just a matter of, I have a strategy that I think is winning, 55, 60, theoretically here with the standard deviation, 68% of the time. Now I need to make sure I'm cutting my losses around the same level of where I'm taking profits. And then as long as I'm right 5, 6, 7 times out of 10, I'm at net profits, baby. So make sure also the place where I look is I'm managing for profits at half the expected move, but I'm also managing for losses. I'm not letting this stuff get carried away, because you can have one trade clear out a month's worth of work, right?
Yeah, absolutely. And I think that the two areas that really kind of, people can get lost a little bit in is if you have this day trade, doesn't matter long or short, right? And it's going against you, where do you cut, right? And so I think you have to realize, like you said, you can set those expectations for yourself. Maybe you cut at half of the loss, or you cut at, maybe the 1 full point, and you say, okay, cool. This, whatever that may be, that depends on your risk tolerance. The other thing is when you're winning, right? And it's to the upside. It doesn't have to be to the upside, but however you want to do it. When you're winning on your trade, where do you cut? And I think, we're getting to the whole idea here. Set those realistic expectations prior to the trade, because I'm telling you, once you get in it, your mind can play tricks on you very easily.
Exactly right. Like I am still to this day a proponent of writing down pencil and paper, like out points, which seems totally archaic, but you got to hold yourself to this stuff one way or another. And what's the silver lining about taking a loss, especially as markets start to heat up here in equities, in crypto, in energy, especially, I mean, if you're trading overnight, and this has happened to me several times, if you're trading crude overnight last night, Jermal, market rallies $5, okay? And the one standard deviation on crude right now is about $2. If I sell those twos, and I have, a half standard deviation management, so $1. So I sell twos, market rallies to 3, and I'm out for a loss. And then the market rallies to 5. I'm jumping back in, man. And then guess what? I can ride that market back $1. And now I'm back at a scratch on an outlier day, a huge day, a day where I should have no business making money or scratching, because as a contrarian, when the market moves out, that's what you don't want when it moves out and stays out like that. So keep in mind that holding yourself to these mechanics on the loss front, it opens yourself up for greater flexibility to get back in or to get into other markets and everything else. It's not just like, I lost, I'll see you all later. I'm giving up for the season,
I think that's it. I was going to hit that and you nailed it. That's the silver lining. It becomes a new trade if you decide to get out for a loss. You're not, beholding yourself to whatever, just happened. You move on. Even if you have a scratch, you can move on and just wait for the next opportunity, which in a volatile market, there's a good chance you get another opportunity.
Exactly right. Exactly right. All right. Well, that'll do it for management mechanics for day trades, but we have a couple of seconds here. So